What if I told you most investors don't lose money because markets crash? They lose money because they don't understand value. In 1934, during the Great Depression, two brilliant minds changed investing forever. They wrote a book that became the foundation of value investing. That book is Security Analysis, and today we break down its most powerful lessons. Security analysis is considered the Bible of value investing. It laid the intellectual foundation for investors like Warren Buffett. This book doesn't teach speculation. It teaches discipline, logic, and financial intelligence. Core lessons from security analysis. 1. Investment versus speculation. Graham makes one thing very clear. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. If you're not analyzing properly, you're not investing, you're speculating. Lesson: always demand safety first, profit comes second. 2. Margin of safety, the golden rule. This is the heart of the book. Margin of safety means buy a stock significantly below its intrinsic value. If a company is worth $100, you buy it at $60 or less. Why? Because markets are emotional. Mistakes happen. Uncertainty exists. Margin of safety protects you from being wrong. 3. Intrinsic value matters more than market price. Markets fluctuate daily, but a company's real worth depends on assets, earnings, stability, competitive position, management quality. Price is what you pay. Value is what you get. 4. The market is emotional. You shouldn't be. Though Mr. Market was fully explained later in The Intelligent Investor, the concept originates here. The market behaves irrationally, sometimes overly optimistic, sometimes extremely pessimistic. Smart investors don't follow emotions, they follow facts. 5. Financial statement analysis is essential. Graham and Dodd emphasized deep analysis, balance sheet strength, earnings stability, debt levels, dividend history, cash flow. They taught investors to read financial reports like detectives. No guessing, no hype, just data. 6. Defensive versus enterprising investor. The book distinguishes between conservative investors, focus on safety, stable companies, aggressive investors, willing to do deep research for undervalued opportunities, but both must follow discipline. 7. Asset-based investing. In many cases, companies were worth more dead than alive, meaning their liquidation value exceeded their market price. Graham looked for companies selling below their net asset value. Pure logic, no storytelling. Why this book is still relevant today. Even in modern markets with AI, algorithms, and high-speed trading, the core principles remain unchanged. Buy with a margin of safety, analyze fundamentals, avoid speculation, stay rational. Markets evolve, human psychology doesn't. Who should read this book? Serious long-term investors, finance students, fundamental analysts, anyone tired of hype-based investing. This is not a get-rich-quick book. This is a build wealth wisely book. If you want to think like the world's greatest investors, you must understand the foundation they stood on. Security analysis isn't easy, but it can change the way you see money forever. And remember, smart investing isn't about predicting the future. It's about protecting yourself from being wrong. If this breakdown helped you, subscribe to Deep Reads Daily, because here we don't just summarize books, we decode financial wisdom.